So where is the Portland market going? We'll be diving into a little bit more when it comes to whether or not it's going to be a huge shipwreck or we'll have smooth sailing when it comes to the Portland housing market. So before I really jump into all of this, just note that I'll be presenting a lot of data, and the main point of what I try to do is educate you a little bit more about the market and understand that the real estate market is very local. So you might be hearing a little bit more when it comes to the national level of the housing and what that means, but just know that this is going to be taking a little bit more of a deep dive on a local level in the Portland, Oregon area. First, we'll be diving into the demand side of things. We'll be assessing that along with the supply. So keep in mind that when it comes to the demand, we're going to be looking at 5 major factors: affordability of housing, interest rates, consumer confidence, population growth, and economic factors. Going into the affordability of housing and the house prices right now, as of December, we saw the median house sale price be around 534. Now, compare that to May of 2022, that was a high of 575. That is about a 7.13% dip in the median sale price. Now, something to also consider is the fact of the year over year, because of the fact that the house prices are seasonal. If we look at that year over year, then it's closer to about 4.49% year over year increase. So with that, keep in mind that diving into the next year, that price might go down. How much is yet to be said, and I'll dive into that a little bit more in the predictions. Now, with the house prices being the way that they are and still increasing, let's take a look a little bit more at the rent versus buy situation that kind of plays a factor into this when it comes to the month-to-month payments. When you're looking at renting right now, that payment's going to be about $2,632 versus a mortgage payment, which is going to be closer to the $3,071. You'll see this large inflection point right here at basically the February, early springtime, and that is really where the interest rates came up, and that's why it's become a lot more unaffordable to buy a home versus just renting a home out. Now, diving into a much larger portion of why 2022 was a crazy year is the fact that we had interest rates go very high. And the main reason for this was inflation. And currently, inflation is just around 6.5%. Now, the Federal Reserve's goal is to get closer to that 2%. Looking at the 12-month average, you'll see that we have a high of 9.1, which was pretty high, and that's a very high year over year. Over time, since the Federal Reserve has increased those rates, we've seen that inflation come down, which has been tremendously helpful for mortgage rates. We saw a large peak in those mortgage rates in the fall period. Around 7.25 was kind of the high, and now we've started to see those come down. Whether or not they come back up or down is another story, and we'll dive into that a little bit later on. So given the fact that the Federal Reserve has risen rates so quickly in 2022, it is unlikely at this point that we will see those rates be hiked up quite as fast in 2023. Now, there will still most likely be rate increases of about 25 basis points over the span of the year. However, we're not going to see those rates jump up by 50 to 75 basis points unless we start seeing the inflation numbers start coming back up, which will become an issue. One thing I want to make very clear is the fact that the interest rates from the Federal Reserve do not always have a direct correlation with the mortgage rates. Just because the Federal Reserve increases their rates by 25 basis points or a quarter of a point does not mean that the mortgage rates increase by a quarter of a point as well. So keep that in mind when you're looking at this and you're seeing what the Federal Reserve is doing. The major reason why they are doing this or having the high rates is so that way they can slow down the economy and slow down the inflation. Until we start seeing those unemployment numbers start going up, they will then know at that point that they will need to come off the gas when it comes to increasing those interest rates. Another major factor to be considering is the consumer sentiment. As of right now, we are seeing that that is relatively low. Now, this can go up and down over time. As you can see from this graph, in the 2008 recession, we saw these rates also drop, and something where people's predictions become a self-fulfilling prophecy. So if they're feeling optimistic, then usually things will go optimistically. And again, this is as a population and has been a great way to see whether or not economies will bounce back or not. However, you can notice that there was an uptick and then downtick and then back uptick. So there might be different factors that happen throughout the year, whether a war started or anything else that may cause different sentiments to occur as well. But as of right now, it looks like we hit a bottom and we are on our way back up. So we'll see how the rest of the year starts, but we need to see a little bit more data into this next quarter to see whether or not we're still seeing that increase. Another factor to consider in the demand side of the equation is going to be population growth. First off, we are hitting a point where a lot of the millennial generation is looking to form households. As you can see, there is a lot of the millennial generation that are hitting the household formation years. The household formation years are typically between the ages of 25 to 54. Now, with this large demographic coming in, they will be wanting to buy homes and start that process. On top of that, looking at the census data, we're also seeing that they are forecasting out that the population will be increasing over the next decade. This will bring additional demand from the people who are moving here. Now, looking at the economic factors, the two major factors we're going to be looking at is the unemployment rate and the median income. If we have a high unemployment rate, that means that there are less qualified buyers. With that median income, if that increases, that means that the affordability will then increase as well. As we take a look into the unemployment rate, as of right now, it is still relatively low. And with that, we would need to see a large change in this unemployment rate and have to get pretty high, close to the 10, maybe 9%. And that change will then help with the potential for having distressed properties, and we'll dive into that a little bit more in the supply side. With the median income, we have seen this continue to rise within the past couple of years and haven't seen it stop quite yet. So with that, you can see with the Multnomah County that we have seen this increase, and we are hovering around 78,000 for the median household income. Now with the Washington County, we have seen that rise up to about 92 grand. And with the Clackamas County, we have seen that rise to about 91 grand as the median household income. Now, these are great economic factors for pushing up the affordability of the houses. However, also usually pushes up the fact that housing prices can go up from there. New construction is going to be a big factor when it comes to supply, because obviously we need to have more homes built in order to meet the demand of the growing population. Now, right now, there is a national supply of about 8.6 months of inventory. And that is a lot of inventory given the fact that the 6-month mark is going to be the mark where anything above that is more of a buyer's market. Now, on a national level, that is great for a lot of buyers. However, when it comes to the new construction in the Portland metro area, it is currently hovering around 2 months of inventory, which is nowhere near that 8.6 months of inventory for month supply. Now, there are 3 major factors that are contributing to this. One is going to be the higher construction costs. And the second thing is going to be the permitting side of things. It just takes a little bit longer to get through permitting. And builders are still very gun shy when it comes to building large amounts, especially since the 2008 crash. When it comes to the third reason, it is because of the urban growth boundary. We can really only grow so much and build homes as fast as we can within that, but given the other constraints, it is a factor for limiting the amount of new construction homes. Through this, you can also see the fact that the new construction homes really hasn't moved at all in this last decade in terms of the volume of new construction. Even through 2011 up to 2022, you're seeing that we have stayed relatively flat in terms of the amount of new construction we are doing compared to the existing inventory. Another note I want to point out is the fact that the construction industry has been moving much more towards the multifamily side of building versus single family homes. So over the last decade, we've been seeing a shift from the single family home construction into the multifamily. Major reason for this has been because of the fact that it's a lot more cost effective to do this instead of buying much more land and trying to fit less units on it. And just to put a cherry on this cake, the fact that the builder sentiment has been decreasing, which means that the amount of new construction will most likely be decreasing over the next year, is going to be a big factor where we will not see a large amount of inventory coming on the market. With existing sellers being another major factor when it comes to the supply side of the equation, we are going to be seeing the fact that a lot of sellers will not be moving. A major reason for this is because they have locked in very low rates when it comes to their mortgage. Now, right now, we will probably still see houses sell because people need to move for whatever reason that might be. But just know if someone's comfortable where they're at and they're not really forced to move, they're probably not going to, because of the fact that if they do decide to move and make that lateral transition, then it will be likely that they'll be paying a much higher monthly mortgage payment. Now, to highlight the point of having a majority of the homeowners not wanting to move because of interest rates, we have in Oregon about 55% of those mortgages have an interest rate less than 4%, and 34% of those houses have no mortgage whatsoever. Now, on top of that, we see that any rate that's below 5%, in Oregon, about 90.8% of all mortgages in Oregon have a rate lower than 5%. So moving into a interest rate with 6 to even 7% does not seem like a great trade for a majority of the sellers. Now, bank-owned properties or distressed properties were a big factor when it came to the 2008 recession. However, at this point, we are not seeing those really creep up in the Portland market. As of right now, we still have a relatively low delinquency rate compared to the national side, where we have about 0.3% versus a 1% in the national side of things. Now, in order for us to see that delinquency rate go up, we would most likely see it a lot earlier, and the signs would be the fact that we see unemployment go up by quite a bit. From there, we'll see delinquencies go up from there, and that will be the 30 to 90-day delinquencies where we'll be able to see that come in, and there might be some subset of those homeowners that might be able to sell before it becomes foreclosed on. On top of all of that, if they do get foreclosed on, that process takes a long time. It takes anywhere between 6 to 9 months for that process to go through. We'd be able to see those ahead of time. So one of the biggest things that a lot of people are looking at is where are interest rates going to be in 2023? Now, let's go take a look into what some major players are thinking might happen. Fannie Mae is predicting that interest rates will again rise the federal funds rate, which will top out at about 5% in early 2023. National Association of Realtors are expecting mortgage rates to settle at about 5.7% as the Fed slows its pace of rate hikes to control inflation. Unfortunately, I don't have a crystal ball, and when it comes to the interest rates, it is going to be something that might change if there is another world event like a war or anything else that might be able to pop up during this time frame. So I can't predict exactly what's going to happen. However, if we do start seeing inflation come down, which we've already seen a trend of it coming down, then the Federal Reserve will most likely be in the second phase when it comes to interest rates, which is going to be getting it up to a point where they hold it or will have it relatively stable. And then once inflation gets down to their core target, then they will be backing off. Now, usually what happens when the Federal Reserve actually does these rate hikes is that they overcorrect. This leads to an economic recession. Now, typically when you're looking at economic recessions in the past, the Federal Reserve will then decrease their rates so that way they can stimulate the economy. Ultimately, this still leads to the fact that the interest rates will be dipping down in some fashion. Now, when that will be, no one really knows. However, it is something that will most likely happen. And with that, know that moving forward that you are looking at this home mortgage and you're going to be thinking that 5 to 10 year plan out, if not even further. Before I dive into any more of this, feel free to hit that subscribe button. It helps out my channel a lot. And if you found any of this content helpful, it would be great if you could also hit that like button. If you have any questions whatsoever, feel free to comment down below. So before we dive into my recommendations for buyers, sellers, and investors, just some things to keep in mind. When it comes to real estate, know that it is a get rich slow process, which means that you need to be looking at a longer time horizon. Yes, prices may fall in the next year or so, even sooner, or we might have already gone past it. It's very hard to time the market. So when you are looking at buying, selling, or investing, know that it needs to make sense for you and will help build your financial future. Something also to note is that you may want to have some flexibility, so having an exit strategy if need be. So maybe when you do buy that property, you have the option of renting it out or figuring out other options that might be beneficial for you. So what does this mean for you buyers out there? With this, we will most likely see prices continue to decrease. How much they decrease is going to be a different matter. Depending on how the supply and demand side comes into this, we'll most likely see home prices dip slightly in the higher ranges and also in the lower ranges stay a little bit more stable. We will also see those prices then stabilize. So the hard part about real estate is the fact that it's incredibly hard to time the market. This goes the same for the stock market. It's very hard to time things. So usually the greatest thing that you can do is make sure that you're looking at that long-term perspective again. One thing I also want to make sure that buyers are very clear about is the fact that we will most likely never get back down to the 3 to 2% interest rates. That was a once in a generation opportunity. And just know that moving forward, a more stable interest rate is going to be between that 5 to 6%. And I would expect even in the next couple of years, even if we do have an economic crash, is to be in that 5 to 6% range when it comes to buying a home. Maybe 4%, but it is not something you should be banking on when it comes to making those monthly mortgage payments and overextending yourself. Buyers have also been able to get a lot more repairs and a lot more negotiating in the last 6 months. We'll most likely continue to see this as the median days on market have been increasing and sellers are feeling the pressure to not be so unreasonable compared to the early time in 2022. So now with that, just know that maybe going in, you might be able to get some closing costs covered. You may be able to get some repairs done, but make sure to talk with your agent and really understand what the opportunities might be and make sure that you are not going in this thinking that you may be able to get a 20 to 30% discount on a house. Another tool to be aware of now is that lenders are offering a 2-1 buy down. Now, I have a video that will dive into that a little bit more. So if you ever want to see that, feel free to comment or message me and I can send that to you. With that, the 2-1 buy down allows you to have a lower interest rate for the first 2 years. Now, how this works is that, let's say you have an interest rate as of right now, around 6%. That first year is going to be 2% less, which means that you will have a interest rate of 4%, which means that your monthly mortgage payment is going to be a lot lower. This will help a lot of first-time buyers who are slowly getting into a position where they know that their income will be increasing, and is a great opportunity for them. Now, in that second year, that interest rate then bumps up to that 5%. So it's only 1% below what it is. That again will allow you to have a little bit more breathing room. And then on that third and final year, you'd have that 6%. Now, the big caveat to this is the fact that you can actually refinance during that 2-year period. Now, let's say that the interest rates drop from 6%, right now we're about 6.5%, down to about 5%. You'd be able to refinance. And on top of that, any of the money that went towards that rate buy down would then be able to be moved towards the refinancing costs of that. So I think this is going to be a great tool for a lot of home buyers who are looking to still get into the market, even though we have a lot higher interest rates. One major thing that I still want to emphasize is that you should still be able to comfortably afford that 6% when it comes to the interest rate, or whatever that interest rate is currently. So that way you are not put in a financially problematic situation. Now, sellers, this is no longer going to be 2021 where you are able to get 50 to 100 grand over asking, be able to sell it within one weekend. We are starting to see a massive shift, and frankly, it's a big reprieve for some sellers as well who are looking to first sell and then buy, or some combination of that. Now, with looking at that data, you saw that the median days on market in early spring of 2022 was anywhere between 0 to 7 days, which means that those homes were flying off the shelves. As of right now, we are looking closer to almost 3 months of the median days on market. So keep that in mind, that when you are looking to list a property, understand the timeline. So if you're listing a little bit more aggressively and have a lower price, you'll be able to sell that a little bit faster. You'll have to know that you'll have to wait for that buyer a little bit longer if you're wanting that higher price tag. So with that, keep that in mind and be able to readjust your expectations. On top of this, know that you may have to offer some sort of incentives, as the 2-1 buy downs, or covering closing costs and doing repairs. Another note is that you will want to make sure that your house is the prettiest one of that weekend, meaning that you want to prepare your house as much as possible. The days where you're able to just put a house on the market and it would sell instantly is no longer happening. So being able to put in the work and make sure that you are comfortable with what that might be is going to be a big factor in whether or not you will want to sell at this point. Another option that you should be looking at is, if you don't necessarily want to get rid of the interest rate that you got that was a low interest rate, you might want to look into potentially renting out your house and seeing if you can then use a HELOC to then get the money for the down payment for the next property. This sometimes works for some clients of mine, sometimes doesn't. So it's a good idea to go over all of these options and really understand what's going to be needed in order to list, now that the competition has become a little bit more fierce when it comes to other sellers. So for investors, we are hitting a point where being over leveraged is not a good idea. Right now, you're wanting to look at deals and be very conservative with your numbers, and understand that making sure that you have a reserve fund, especially if things go sideways, is going to be a critical part for making sure that you are able to stay in the game of real estate. Because remember, when it comes to the real estate game, you're going to want to stay in it as long as possible, because real estate is a get-rich-slow process. For my fellow house hackers out there, one of the major strategies that I've been telling clients to do is moving more towards looking at single-family residences. Now, this is primarily because there's not a lot of multifamily out there in the Portland metro area. However, the loans for single family are a lot easier to get, and there's also rehab loans and a variety of other loan programs that might be available to you to make sure that you can potentially get a ADU added, and usually making sure that that ADU is a part of the initial structure, or you could put a pad for a tiny house to be rented would be also another opportunity as well. If you want to dive into a little bit more about what that might be, feel free to reach out as well. Now, we have also seen a small revival in a program that allows for about 5 to 10% down when you have an owner-occupied small multifamily. So if you ever have questions about that, feel free to reach out as well. That will give you an opportunity to buy a home and have a relatively low down payment as well. Diving into the overall predictions that I am seeing or expecting. Note that I'm personally using this advice to guide my own decisions. And when it comes to the interest rates, I am going to guess that they will be coming down. How much is a different story. Now, I do expect that the interest rates will continue to stay in around the sixes for the majority of the year. And as long as inflation continues to go down, we will most likely see those interest rates either stay around that 6% or start heading down and softly coming down. So I don't see a large decrease in those interest rates down to either 4.5 to the low fives. However, that might be a possibility, just fairly low at this point. Now, a major factor that I'm also looking at is the unemployment rate. If I start seeing that go up by quite a bit, I know that we are going to be in a larger recession, which means that those interest rates are still going to come down because the Federal Reserve will then see that they've caused enough economic damage or economic hurt or slowed the economic engine enough, and they will then start reversing course, which means that they will then decrease the rate. So something to just kind of keep in mind when moving forward, and two factors to kind of play around with, especially when you're looking throughout this year. So a big question is whether or not the home prices will dip. And unfortunately, again, I don't have that crystal ball. However, with the current data I've seen, I am going to be expecting the home prices to dip another maybe 5 to 10% at max. However, it will be differing for different parts of the market, with a majority of the higher end properties seeing that larger dip. However, the starter homes still being relatively stable in terms of price. The main reason for this is that there is a huge demand from the millennial generation in terms of wanting to buy a home. And I do see right now that population is still looking to buy right now and is just waiting for the right property. Right now, we just haven't had a lot of properties, and I've probably had at least 5 to 10 conversations with buyers who are getting ready to buy this year. So with that, I do expect a large demographic of the younger home buyers to buy those starter homes, whereas the higher end properties, maybe closer to the $800,000 to $1 million mark, will most likely have a larger softening in terms of prices. Let me know if any of that was helpful. If you have any questions whatsoever, feel free to message me or comment down below. I'd love to help you out. Thank you so much for watching.